Bismillahirrahmanirrahim. Assalamu alaikum. I am Sayyid Akif Shah, lecturer finance at Institute of Business Studies, Kohat University of Science and Technology. The title of this course is Financial Management, and the course code for this subject is BS 251. This is our lecture number 30th, and the topic for today's discussion is account receivable management. As this is a very broad topic, so it has taken series of 4 lectures to complete the discussion over the account receivable management in a typical manufacturing firm. Today we are going to conclude our discussion on this topic by further elaborating the collection policies and the procedure adopted by a typical manufacturing company while they are adopting or while they are looking to collect their account receivable efficiently. So what are those policies and procedures usually used by a typical manufacturing company will be discussed shortly. Beside that, we'll also look the sequential investigation process for analyzing the credit applicant. That is, when a credit applicant approaches to a manufacturer of certain products or commodity and they apply for credit purchase to that specific firm. So what could be a sequential investigation process used by that supplier to investigate the credit worthiness of the credit applicant so that they may be easy to decide either to accept the credit application or to reject their application. So let's move towards our outline of this lecture. The outline of this lecture will address the broader topic of account receivable management, under the umbrella of which the specific discussion under this lecture will be on the collection policies and the different procedure used by a company to expedite their account receivables collection, or simply what could be those procedures or methods or technique used by a company to collect their account receivable as soon as possible. Secondly, we'll see how a company may analyze the credit applicant by using different financial ratio techniques and as well as certain other procedures used for analyzing the credit applicants in order to find out whether the credit applicant is trustworthy or not, so that they may be easy to either accept the application of that credit customer or to reject that one. Finally, we'll see a sequential investigation process used by a company to investigate the credit applicants when they receive an application for the purchase of certain product on credit or loan basis. So let's move ahead with the learning outcomes under the broader topic of account receivable management. As this lecture is in continuity to the previous 3 lectures, so I'll little bit emphasize or will explain the few learning outcomes what we have already achieved in my previous lecture. So in order to have grip on the first learning outcome, which is to list the key factors that can be changed or varied in a firm's credit policy, and to understand the trade-off between profitability and cost, as we have already explained that what was the trade-off between profitability and cost involved if the company was changing its credit policy. So this learning outcome has already been achieved. We have also learned how the level of investment in account receivable is affected by a firm's credit policies. That is, when they are going to make less stringent their credit standards or to relax their credit period by extending more number of days to pay their obligations to the company. In that case, our level of investment in account receivable increases. So we have discussed in detail with the numerical example already in the previous lecture. So this learning outcome has also been achieved Thirdly, in this account receivable management topic, we have critically evaluate the proposed changes in the credit policy, including the changes in credit standards, credit periods, like extending the number of days allowed to the credit applicant to pay out their debt obligation, and as well as the cash discount provided to the credit customer in order to expedite the collection process. So basically, we have achieved our 3 learning outcomes in the previous 3 lectures. We have discussed in detail with the help of numerical example and as well as certain scenario based cases. So the final learning outcome under the account receivable management is to describe the possible sources of information on the credit applicant. So after listening to this lecture, you will be able to know what could be the sources of information for a company to have on a credit applicant when they are approaching to the company for purchasing their commodity on credit basis. So in that case, the company will use certain sources of information, and what are those will be discussed shortly in this lecture, and this is our primarily learning outcome of this lecture. Besides this, you have to like how you might use this information. The second step is, after analyzing or finding out those sources of information, how this information can be used to analyze a credit applicant will also be discussed. And after listening to this lecture, you will know or will have a grip on the different sources of information when the credit applicants approaches to your company for purchasing your product on credit basis. So let's go ahead towards our main topic. Let me move forward, as we have already discussed the account receivable management in detail in our previous lectures. So the emphasis over here is the collection policy and procedures adopted by a typical manufacturing firm. So this way you can see that we got a couple of techniques for collecting our account receivable, which are named as collection procedures. So the collection procedure used by a company is number first to send the letters to the credit applicants. So the first method is to send a hard copy letter or email to the credit applicants and to claim that they have to, or to remind them that they have to pay their obligation to the company as they have purchased certain commodity in past. The second source or second procedure could be to make a phone call to the designated number of their businesses to the customer directly on the number provided by them, and you can give them a reminder call to expedite or to pay out their obligation on due time. If they are not responding to the company's letter, and as well as the credit applicant is not answering the phone calls, the third step for a company is to make a personal visit. So the collection personnel of the company will make a personal physical visit to that credit applicant, or rather I must say that credit customer who have already purchased the product from our company. So our company personnel who is in the collection department will make a physical visit to them in order to ask for the collection of account receivable. And if still they are not responding and refusing to pay out their obligation to the company, then the final procedure left with the company is to take a legal action. That is to sue the credit applicants, not the applicant in fact, but the credit customer, because they have already purchased our product. So the final step number 4 left with the company is to take legal action and to sue the credit customer in the court and to collect their money or account receivable against the credit sale. So these are certain collection procedure used by a typical manufacturing company. Beside that, we can use different procedures like the personal visit uh, require the company to hire the personnels, and then those employees will definitely be given with salaries. So that salary or collection procedure actually increases our collection expenditures, as these are not free. You have to post the letter with the help of courier, so you have to pay certain amount of money as a courier charges. We have to bear the phone calls charges. Similarly, the personal visits will definitely require the firm to hire certain credit collection employees, against which they have to pay the regular monthly salaries. So this is expenditure number third. And finally, this taking legal action and bringing the credit customer into the court is definitely not free of cost. So you have to pay the legal or litigation charges as well. So certain expenditures are there to collect their account receivable from the credit customers. So we can explain these expenditure with the help of a diagram, as well as on the x-axis you can see that there is a collection expenditures whereby the company, when they are actually receiving, are trying to expedite the collection. And the more sophisticated collection procedures company adopt, the less bad debt losses normally occurs. So on the y-axis there is bad debt losses. So we can see that the collection expenditure is our independent variable and the bad debt losses is the dependent variable. We can see that if we increase our collection expenditures, the bad debt losses gradually start to decrease, because the more sophisticated techniques we are using to manage our account receivable efficiently, the less bad debt losses usually occurs. So up to what level a company should increase the collection expenditures? For this purpose, you have to come on this rectangular narration. The firm should increase the collection expenditure until the marginal reduction in the bad debt losses. Like at one end, you are increasing your collection expenditure from $10 to $20 to $100 to $200 and so on and so forth. So until your collection expenditures, until the marginal reduction in the bad debt losses equals the marginal cash outlay to collect. Like this narration means that the company should increase its collection expenditures until and unless the marginal reduction in bad debt losses is equal to the marginal collection expenditure. Like if suppose on this specific saturation point, the bad debt losses with the company is, let's suppose these are only $100. And if company is looking to increase their collection expenditure by $100 and still it is not going to reduce the bad debt losses to zero, rather it is actually reducing towards $80. So in that case, we can see that we have actually spent the greater number of dollars to decrease the less number of bad debt losses, which is in this case only $20. So we are actually saving $20 by increasing the collection expenditure up to additional expenditure of up to $100. So this definition or this rule states that until the marginal collection expenditure is less than the decrease in the bad debt losses, we are going to increase our collection expenditure. And when the firm increase their collection expenditure but the decrease in the bad debt losses is quite less than the additional or marginal increase in the collection expenditure. In that case, we have to stop over there. So we can see that if we increase our collection expenditures, like using more sophisticated technique to expedite our account receivable collection, the bad debt losses usually start decreasing. And here is our saturation point. That is when the marginal collection expenditure equals the bad debt losses decrease. So we have to stop over here, and we cannot minimize our bad debt losses towards totally zero bad debt losses, which is not worthwhile because our marginal increase in the collection expenditure is quite greater than the decrease in the bad debt losses. By bad debt losses, we mean that certain credit applicants or credit customer does not pay to the company in future, or rather those account receivable turn out to be uncollectible and then later on written off from the book of account of the company. So our main focus in account receivable management, or one of the main focus, is also to decrease the total bad debt losses incurred by the company. Let's move ahead. Analyzing the credit applicant. Let's see how a company can analyze or check out the credit worthiness of a particular credit customer when they are approaching to our company. So we have to obtain the information on the credit applicant, like usual information, their name, their other particulars, and as well as in past from whom they were purchasing. Secondly, analyze this information to determine the applicant's credit worthiness. So the first step is to collect the important preliminary information. The second step is to use that information for judging the credit worthiness of the credit applicant. Thirdly is to either to sanction or accept their application, or to reject their credit application and not to provide them sales on credit basis. So we have to make the decision. So let's discuss one by one how to obtain the information, how to analyze, and how to make a credit decision. So what are sources of information about the credit applicants? The company must weigh the amount of information needed, like what type of information is required by the company versus the time and expense required. So definitely this information is not free of cost. We have already studied in the time value of money chapter that time is our money as well. So one should not waste this time, because this time does not stop for anybody. And when we are utilizing our time on collecting just the information about the credit applicant, which is not worthwhile, will definitely waste our precious time. Secondly, the company is definitely going to bear certain expenditures or expenses to obtain that information. So what are those expenses will be discussed shortly. So what is the amount of information? So we can demand the financial statement at step number first. We can ask our credit applicant to provide us their financial statement if that is a retail business. So a registered business is legally required to make their financial statement and to adopt the accounting procedures. So we can check out their financial statement, which are balance sheet, income statement, statement of owner's equity, and retained earnings statement or cash flow statement as well. So we have basically 4 financial statements, which are balance sheet, income statement, and cash flow statement, and statement of owner's equity or owner equity statement of owner's equity. So these are basically 4 financial statements which are really worthwhile for our company to take the preliminary important financial informations. As we know that balance sheet tells the financial positions of a company or that firms which is actually approaching as credit applicant to our company. The income statement tells us that whether the company is in profit or loss. The cash flow statement tells us the cash position or cash inflow and outflow with that particular company. And similarly, the owner contribution or risk minimizing portion of capital could be judged from the statement of owner's equity. So first of all, a company will require the credit applicant to furnish their financial statement for at least 5 to 10 previous years, which we can judge that either the company is in a sound position or that particular credit applicant, which might be a legal business, is in the sound condition to be sanctioned with the credit sale or to reject their application. After that, we can also check out the credit applicant information by approaching the credit rating and reports. So credit ratings, there are certain companies which usually rate the other or different kind of businesses available in that specific market, like Moody, Fitch, Standard & Poor's, and as well as Dun and Bradstreet. So these credit rating agencies usually provide the information regarding all companies, and definitely they are going to charge us for providing the information pertaining to that specific credit applicant. If, for example, if Mr. A's or Mr. A company is approaching our company for purchasing the credit product, so the information about the firm A will be provided to our company by the credit rating agency at certain cost. So here is our supplier or our company, and this supplier will or can use the credit rating agencies to obtain information about the purchaser or credit applicant. So I am using purchaser over here. Beside that, we can take information from bank checking. Like we can approach the bank where the account of this credit purchaser exists, and we can find out the detail about the behavior and attitude and as well as the dealing of this credit applicant. Once again, the bank is going to charge us for the information, so we have to carefully analyze our credit applicant. Step number 4 is to check the trade checking, like what is the behavior of this credit applicant Mr. A with the other different suppliers available in the market. So you can check out their past practices with other suppliers. Step number 5, you can, if this credit applicant is our old customer, so the company's own experience may also be utilized to judge the credit applicant's application for further sanctioning the credit sales to this particular firm. So our own experience, like in the past, if this firm was not paying their obligation on due time, so our decision will be to reject their credit application. And if the past experience of this credit applicant with us is quite good and fair, then we'll further extend the credit sales to him and to accept his credit application. So these are certain sources from where we can get the information about our credit customer. How to analyze? A credit analyst is usually hired in a supplier company or in a company, is likely to utilize this information regarding the financial statement by using it as a ratio analysis, which I have already explained. Company can use for ratio analysis, like they can use the current ratio, quick ratio, return on equity, return on asset, and debt to equity ratios. These ratios are helpful for our company to find out that either they will be able to pay out their obligation on due time or not. We can also use inventory turnover ratio and account receivable turnover ratio of that credit applicant as well, because that ratio will tell us that they're able to pay out their obligation in the future or not. Secondly, we can see the character of the company. Character of the company means that this credit analyst who is in the supplier company will going to check out the character of the company. Like, so there are certain companies which are approaching our company or suppliers for credit purchases. However, their behavior is not good with the suppliers and they usually delay their payments. The third step is to check the character of the management, like in the top management, what kind of people are residing there and what are their behavior and attitudes towards their payment on credit purchases. Fourth, the financial strength of the company or firm will be checked with the help of balance sheet and income statement, where we can analyze their financial strength. Finally, the other individual issues specific to the firms, like if there is any union and labor strike, etc., going on in that firm of credit applicant, then we can say that in future they will be unable to pay out their obligation. However, if there are not any such kind of issues available in the companies, then our credit analyst will give a green signal to accept his credit application and to sanction the credit sales to him or to that specific firm. Let's discuss the sequential investigation process, like how in a typical manufacturing firm, when a credit applicant is approaching to the company, will be investigated. So the cost of investigation is balanced against the cost of investigation. As I have already explained, that the company is going to bear a cost to investigate the credit applicant should be balanced against the expected profit from that order. So if the expected profit from a credit applicant's order is greater than the cost of investigation, like I'm using $sign over here to represent the cost incurred, and here is profitability. If the expected profit of that specific order is greater than the cost of investigation, then the firm will definitely accept the order. So determining the type and amount of information collected. So in the next 3 slides, you will see the sequential investigation process used by typical firms or manufacturing firms. So usually this kind of flow chart is used by different suppliers to investigate about the credit applicants. Like, for example, we got a supplier represented with S and a credit applicant is represented with CA, and this credit applicant has given an order to the supplier and this order is at this stage pending position. So let's move towards stage number first, and stage number first requires to bear $5 cost by the supplier. So in this stage, first of all, the supplier will look at the bad past credit experience with this particular credit applicant. So if in the past this credit applicant was not dealing fairly with the supplier or with the company, then his order will be rejected. So if there is any bad experience in the past, this pending order will be rejected. However, if there is no bad experience and after checking the procedures are dealing in past with this credit applicant, the stage number 2 will move to the stage number 2 to investigate about the credit applicant. And in stage number 2, usually we incur or the supplier incur $5 to $15 of cost, because in this stage number 2, the supplier is now approaching the Dun and Bradstreet report analysis. Now, what is this? This is usually rating agencies are there in the market, like Dun and Bradstreet. Nowadays, you can see that Broad Street is also there, who is actually figuring out the fraud and other bad activities by different individuals and companies. Beside that, in the financial markets, we have Moody, Standard & Poor, and Fitch. These are companies which are regularly rating the different firms in the market, and they usually provide the ranking between high and limited gauge. The high, if a particular firm or credit applicant has 1 rating by Dun and Bradstreet, it means that this credit applicant is very nice and good. And if this Dun and Bradstreet award 4 point to a particular credit applicant, it means that this customer or this credit applicant is having a limited title, and by limited they mean that the performance of this credit applicant is poor on their obligation. So we can use the Dun and Bradstreet report analysis. So this arrowhead is telling us to move to the next step. So the next step is that if the credit rating given by Dun and Bradstreet is limited, as I have already explained that there are 4 gauges starting from high, second good, third fair, and fourth limited. So if the credit rating is giving limited title to a particular credit applicant and other damaging information is unearthed, then in that case our supplier or our company's decision will be to reject the application of credit applicant. However, if there is no limited, rather a fair and good sample is awarded by the Dun and Bradstreet to a particular credit applicant, in that case we'll move to the next step. If this is no, then we have to see that if the credit rating is giving the title of fair and or other close to the maximum line of credit. What is line of credit? Like the maximum amount of credit a particular firm can obtain from the bank or any other suppliers. So if they are approaching close to the line of credit, or they are having fair credit rating by Dun and Bradstreet, if yes, then we will go for further investigation. If they are not given with such kind of fair and close to the maximum of line credit indication, then our supplier or our company will accept this credit applicant and sanction the credit sales to him. However, if certain dangerous title and rating has been given by Dun and Bradstreet, then we have to further investigate the credit applicant and will move to the third part of this diagram. So in the third step, which is stage number 3, and if the company is following this stage as well, so a typical cost incurred by the company is $30. And in this step, the supplier is going to approach the bank, the other creditors, and the financial statement analysis of the credit applicant, which will assess to either accept the credit application or to reject the credit application by this credit applicant. So after analyzing the bank record and other creditors records, and as well as analyzing the financial statement of at least 5 years in the past regarding this credit applicant, and after this analyzing the result is good, then the supplier is going to accept the credit applicant and will sanction the credit sale. If the result come up with fair, then the supplier will accept only upon the domestic irrevocable letter of credit. Now, what is irrevocable letter of credit? We'll discuss it shortly. And if the resultant result of bank credit and financial statement analysis is poor, then in that case the supplier will reject the credit applicant's application and will not sanction the credit sales to him or to that particular firm. So this is all about the sequential investigation process used by a typical supplier or manufacturing company when the credit applicants are approaching to purchase the commodity on credit basis. Certain other credit decision and issues, like we can also, or supplier can also use a credit scoring system where on different specs like option A, 2, 3, 4, on different 4 aspect, company is going to, a supplier is going to rate or gave scoring to particular credit applicant, and those who are receiving the maximum score, their credit application will be accepted, and those obtaining the less score, their credit applications will be rejected. So this is basically on different aspects like on financial ratios, financial health, and their ability to pay their obligation in the future. So basically it is a system used to decide whether to grant credit by assigning numerical scores to the various characteristics of credit worthiness. So on these various characteristics of 1, 2, 3, and 4, and so on and so forth, up to 10, 15, or whatever criteria the company may decide, on those factors, the credit applicant must prove their credit worthiness. And those who are successfully achieving the maximum score will be granted with the credit sale, and those who are obtaining less score, their application will be rejected. Secondly, after that, we have another topic which is known as line of credit, which is the maximum amount of credit extended to particular account. So line of credit means like one particular credit applicant can take loan starting from $0 to up to, let's suppose, $1 million. Like, so this is the total limit of the credit customers or credit applicants. So this, if the maximum of credit purchases has already been obtained by a particular credit customer, in that case his line of credit is over and no further credit sales will be granted. So what is this? A limit to the amount of credit extended to an account. Purchaser can buy on credit up to that limit. So this is what I have already explained to you, and it streamlines the procedure for shipping the goods and as well as to have a good account receivable management. Looking ahead, in order to efficiently manage your account receivables, certain companies go for outsourcing credit and collection policies. Like this is a quite complex and difficult process to adopt for sanctioning and sanctioning credit and collecting the account receivable. So usually what the companies or supplier does is to outsource the credit and collection policies. What is outsourcing? Like selling out your account receivable or factoring account receivable to an independent companies, and they will collect your account receivable on your behalf. Otherwise, beside this, the company can outsource, like they can give the part of the credit and collection department to the independent unit for allowing the credit to the credit applicants and as well as collecting the account receivable. So when the entire credit and collection functions are outsourced to a third party or independent company, in that case company is free from different hectic activities to perform. Rather, this independent third party company will perform all the credit and collection procedures on the behalf of the suppliers with customers. So the credit decisions are made by the outsourcing, the ledgers account are maintained by this third party, the payment processed and as well as collection initiated by the third party if we are approaching towards outsourcing the credit and collection procedure of the company. So these decisions are based on the core competency of the firm. If the firm is quite well enough to manage their account receivable efficiently, then no need to go for outsourcing your credit and collection department. However, if the company is poor in collecting the account receivable or cannot manage their account receivable well, they are going to adopt the outsourcing credit and collection option. So this is all about, and here we are going to conclude our discussion of account receivable management. This was all about the different techniques adopted and different standards and cash discounts offered to the credit customers for efficiently managing our account receivables. And finally, we have concluded on the discussion of sequential investigation process, so that we must select only the quality of credit accounts. Thank you very much for listening to this lecture. If you have any question pertaining to the account receivable management and as well as specifically regarding this lecture, you are free to ask your question on the system, or otherwise You can email me your queries on my email address as mentioned in the footer of this lecture. Good luck for the day. Allah Hafiz.